British pound is under pressure, government borrowing costs are spiking, and Prime Minister Keir Starmer just delivered what could be the most consequential speech of his premiership. If you thought Brexit was the end of Britain's economic turbulence, think again. This is about survival, not just for a government, but for the credibility of an entire economic model. Here's what happened. UK gilt yields, essentially the interest rate the British government pays on its debt, surged to levels not seen since the chaos of Liz Truss's disastrous mini-budget in 2022. 10-year gilt yields topped 4.8%, sending shockwaves through London's financial district. Higher yields mean the government must pay more to borrow, squeezing the budget just as Starmer promised billions in new spending on healthcare, infrastructure and defence. In his speech, Starmer acknowledged the crisis head-on, saying growth, defence, energy security and relations with Europe cannot wait. Translation: we're in trouble and we need solutions now. Markets are responding with brutal honesty. The pound fell sharply against the dollar, hitting multi-month lows as currency traders bet on prolonged economic weakness. UK equities, particularly the FTSE 250, which tracks domestic companies, dropped as investors worry higher borrowing costs will choke off growth. Government bonds sold off hard, the opposite of what you want when you're trying to fund ambitious plans. Meanwhile, gold rallied as a safe haven, and European stocks felt the contagion as uncertainty about Britain's stability spreads across the Channel. This isn't just a British problem anymore. Who wins? Defence contractors may see a boost if Starmer follows through on increased military spending amid rising global tensions. Energy companies focused on renewables could benefit if his government accelerates green energy investment to reduce dependence on volatile fossil fuel imports. Financial services firms that help restructure debt or manage currency risk are busy. Who loses? British banks face margin pressure and potential loan defaults if the economy weakens. Retailers and property developers relying on consumer confidence are taking a hit. Exporters lose as a weaker pound makes imports more expensive, raising costs. And pension funds holding gilts just watch their portfolios lose value. Europe is watching closely. Ireland and France, both with significant trade ties to Britain, face potential spillover if UK demand collapses. Germany's export-heavy economy could suffer if British consumers tighten their belts. The US benefits slightly as a stronger dollar makes American goods cheaper for Europeans, though a UK recession would hurt American multinational revenues. Emerging markets that rely on stable Western demand feel the chill. And there's a geopolitical dimension. A weakened Britain is a weaker NATO partner, raising questions about European defence at the worst possible time. UK unemployment, currently near historic lows, could tick up if businesses postpone hiring amid uncertainty. The public sector, already stretched, faces painful choices between wage increases for nurses and teachers versus fiscal discipline. Commercial real estate, especially in London, is vulnerable as higher interest rates make property investments less attractive and financing more expensive. Residential property markets could cool further as mortgage rates stay elevated, pricing first-time buyers out and stalling transactions. Watch the Bank of England's next move. Will they hold rates steady to support growth or hike to defend the pound and control inflation? Watch for any formal announcement on spending cuts or tax increases, which would confirm how dire the fiscal situation truly is. And watch Brussels. If Starmer pivots toward closer European ties to boost trade, that's a game changer. The next few weeks will define whether Britain stabilizes or spirals. Stay informed, stay ahead. This is World Financial News.